All right. Good morning, everybody. So yesterday was pretty awesome. All we had to do was get out of the box, and we managed to get out of the box. Today, we have the opportunity for a gap close play, but we have a lot of stuff on the table today. I mean, it's going to be coming at us all day long. And if we're really lucky, we're going to get the narrative set pretty early in the morning at 8:30. And after that, that one narrative overriding everything else would be fantastic, right? That'd be kind of the best scenario. I mean, just a second. Seems like something didn't post. See if that gets it fixed. All right. So that's the hope today, is that we can set the narrative from one single event and have that override all of the other events for the day. But that's a big ask. And, you know, they say hope is real, but it's a really bad trade strategy. So we can hope we get it, but I wouldn't try to plan for it. We have the 5-year tip auction today. ECB Lane is going to be talking, so more stuff out of Europe. Then we've got Governor Bailey. It's just all day, right? Man, Bailey. We're going to get some manufacturing activity. So these initial jobless claims, this goes to the heart of the Fed's mandate, and it's a lot of what we saw yesterday with the move to the South. The indication about the Fed and the hint that they may or may not cut. As we've talked about before, you can always go to CME FedWatch. You don't need to, just sit there and stare at this all day. But if they are reshaping their expectations and we think the market is moving because of those expectations, then you can come into the FedWatch tool and see, well, what are they doing? Are they trying to unwind their expectations that are already priced in, or are they trying to price in expectations that aren't yet there? This isn't a perfect tool, but it can go back from a month, and then you can see what it was a week ago, what it was yesterday, and then, of course, where we are now, to see if they are, pricing in or unwinding something that already was priced in. The Fed has a dual mandate, right? One side is inflation, the other side is employment, and they've already sounded the bell and took a victory lap on slaying the inflation beast. And now their focus is on jobs. So every single jobs data print that we're going to get, everything from JOLTS to unemployment, non-farm payrolls, anything jobs related, is an opportunity for things to go sideways and for the markets to really get that liquidity. It went down. Remember, we were at 250, I think it was 250 or 251. And then in the initial jobless claims that we got last time, it dropped us down to 241. Now the consensus is that it's only going to rise just that one tick from 241 to 242. I don't think so. And this is why I think we could get some volatility today. If everybody thinks we're only going to get this little one tick increase and we get a significant increase or decrease, because I mean, it can continue to fall. It went from 250-ish to 240. We could see it drop again. So it doesn't have to just be negative and going up. A surprise number there shakes the entire day, so that all of these other things, while they are generally important and you want to keep track of them, they could be eclipsed by that initial 8:30 print, and then the whole day is focused on that. We have to believe that with the hurricanes and everything, there's going to be a short-term rise in the initial jobless claims. That makes sense. And a lot of analysts will take that into consideration. But then there's the splashy headline, and then there's the revisions when nobody's looking. We still want to pay particular attention to the rest of the events on the day, no matter what the job numbers are. But really, my base case argument for today is that the jobs numbers are going to take precedent, and everything else is going to just lose its value of importance. So with that in mind, we have the gap close play today, the possibility of getting this gap close. This is different from your typical gap. The typical gap is a gap in price, where we look at something like yesterday's close being at $100 and then today's open being at 105, and we say, oh wow, there's this gap between where we closed and where we opened. This is a different gap. This is focused on liquidity. At 8:30, we're going to get data. The initial move out of that 8:30 candle is where the gap is created, and we're working on getting back to where that gap was started so that we can close the gap. So wherever we're at 8:30, that's where you snap the line, and it's where we want to focus on getting back to. Now, as a trade, I'm very particular about this one. It needs to look a certain way, or I don't want it, and I'll trade something else, right? Not a different product necessarily. I'll just trade a different setup. So for this setup, I don't want the wick going in the opposite direction. So in this one, we went down. I don't want to see a large up wick here. And at the end of the move, I don't want a large wick down there either. It needs to look a lot like this, a very large move in one direction without a lot of wicks. We got this gap closed around 11 o'clock. That's pretty common for this. 10:30, 11, either one. Here's a different example going to the upside. Almost no wick on the bottom. Almost no wick across the top. Got the gap closed around 10:30, overshot it. This one's a little bit different. It's CPI data. Moved in the right direction, and then we pulled back a little bit. If you break that candle down into quarters, all right, like $1, you get 4 quarters. They're not equal there, but you get the idea. It needs to close in the upper 25%, or if we had gone down, it needs to close in the lower 25%. It did that. Then the next candle stayed within that zone. It didn't fall back down to the half and go underneath the half. Then the next candle opened and we continued the move. It also closed near its own high, and then the next candle, and then we started to get that base built. We got the gap closed before 11. Everything, while this one looked a little bit different, it had the key starting point with no wick going in the opposite direction and closing in the upper 25%. So don't think that the entire move is done just when you get that first candle. You could get more than one candle in the run. Now, I am using a 5-minute chart for all of this, but these are the way that I play it, and I like to use a 5-minute chart when I'm looking at candles and doing analysis on candles. I don't trade the 5 necessarily, but it is my preferred time frame for doing these sorts of measures and analysis. Use yours, right? Whatever time frame it is that you like. You can always go back in the past and find these events. A simple Google search will tell you when the last non-farm payrolls were, or CPI, PPI, unemployment. Just go back to that day, find that big candle using the time frame that you like, and really examine it, see if there was a liquidity play that day. So this is non-farm payrolls, and you can see how we closed near that midpoint. We fell back a long ways and left that huge wick across the top. But even before we got that, we had this wick along the bottom. We don't want to see this sort of move in the opposite direction of the initial push. We don't want that. This did get the gap closed, but this wouldn't be one of the gap close setups that I would trade. And of course, even if we don't trade this gap close, we can use that candle for laying out our levels on the day. We used this halfback and it offered an opportunity later. Even though price had cut through this zone multiple times, when we later got there, price responded to where that 830 open candle was. And then on our breakout, we went through the liquidity and hit the OCC level. OCC stands for opposite candle color. And that's exactly what happened. We got there, we got our opposite candle, and we came back in again. So even if we don't get the gap close today or the gap close setup, we can still use this really big candle if we get one, right? We may not, I can't guarantee that we're even going to see a big candle, but I'm pretty sure we're going to see a big candle. Can't make price do something, right? So here's an example of what we don't want to see. We don't want big wicks on each side with a small body and price closing near where it opened. This kind of defeats the whole purpose, right? Now, again, you can use that really big candle, project higher 50% on 100%, which is where the high of the day was made. It was based off that 50% projected higher. And even on pullbacks through the day, we could look for a halfback retest, right? So even if we don't get our CPI, PPI, non-farm payrolls, unemployment, big liquidity gap play, we can still use the big candle if we get one. Same thing, another example of what we don't want, big wicks on each side. Same thing here. This is what we don't want. I show the examples of what we don't want because if I only show you the trades that worked and the setup that worked, then it gives you the false impression that we're going to get that all the time. And we don't, right? Sometimes we don't get the big candle, or sometimes we get the big wick on each side and we don't get the setup. So I think it's useful and fair to show you the ones that didn't work. These gap close plays can happen anywhere. I'm focused on the 831 because it's like knowing when lightning is going to strike, right? If I know at 830 we could get a big candle, then I can focus on 830. But the thing is, we can get them anywhere. Here's one that happened at 10 a.m. and it was open all day. It got closed at 3 o'clock. But throughout the day, even after we got that one, we got another one at 12:30, which was closed before 1. Then we got another one around 3. We closed the first one before 3:30, and we closed the 3 o'clock one before 4 o'clock. So these can happen all over the place, and it can be on whatever time frame you want to use. It's called a liquidity gap, not a price gap. So 8:30, 8:45, 9, 9:45, 10, 10:30, 11, 11:30, 1 o'clock, 3 o'clock. And if you're still trading at 3:45, there's one there as well. In the overnight, if you're thinking about swinging anything, we're getting more data out of Japan. So there's that too. Full house. UPS put out good numbers. I haven't had a chance to go through everything yet, but they are a bellwether company. When they report, you want to pay particular attention to what they have to say about shipping and demand. I haven't had a chance to review it yet, but considering that it had a positive move, I'm going to go out on a limb here and say that their forward projections were good, or the market probably would have sold them off. Today's one-day estimated move to the downside is right underneath 58.11 COG line. It's close to yesterday's low, but to get there, we will have to cut through the volatility trigger and the zero gamma. To the upside, we're almost there. It's at 58.80. If this is a dead cat bounce that runs into resistance, I like 58.92 COG line for that resistance. If you think about, a dead cat bounce where we're just headed lower and lower, then that 58.92 would be a nice overshoot. But to even get there, we've got that ADR half in the way, and the one-day estimated move is also in the way. If we can get through both of those, then we could overshoot into that 58.92. But not expecting much beyond that. Certainly not thinking about 5,900 or getting up into 59.20 and 59.11 COG line. We haven't earned that yet, right? And with the election and everything else still weighing on market sentiment, I don't see that we're going to get into like 59.32 COG line. We are close to the ADR half. When we get this close, we say it's likely we're going to hit it. Now, because we've got Econ, in about 45 minutes, it's possible that we hit that level even before we get the unemployment numbers. Once we get the data print coming out, then all bets are off. It could go anywhere. No pivot can stand in front of an economic event. We are through the half if we measure all of yesterday. And if we just take the RTH, then 58.75, which would be a little bit of an overshoot from the ADR half, that would be the area of concern. And then, of course, we're going to get data. So this is a good example of the weekly pivot and expanding away from it and now trying to come back towards that pivot. This wasn't what we would say too far, especially since that's the weekly level. In previous moves to the downside, we've expanded it over 6% away from that floor pivot. So this move yesterday, that wasn't very much, right? All things considered, especially what we've seen in the past. But when we're underneath the pivot, that puts us in a bearish posture. And now that we're moving back towards the pivot, it does become a bit of a goalpost, which fits into my 58.92 dead cat bounce target, right? If this is a dead cat bounce and we're running back to the upside, 58.92 works for me. And that lines us up close to that weekly pivot. Today's channel opened lower than yesterday's. That's bearish. Price opened underneath the channel. That's also bearish. We are above it, which means we've already hit the floor pivot for the day. The idea that now that we're above it, we need to keep it. We don't want to get back below that floor pivot. Otherwise, we're looking to retest yesterday's low, and then we would use the liquidity zone and OCC below yesterday's low. It's really simple to lay that out. Just snap a fib line with the 111 on there and the 1236. That'll be your liquidity zone, and that would be your OCC. OCC, opposite candle color. Otherwise, a move to the upside offers us a chance to do the same thing. Take the same drawing, flip it around, and you've got 111 up here. You got 1236 up here. Without the floor pivot and its channel and all these clouds, it would be easier to see, but it's 5904 and 5915. All right, looking at the weekly pivot, we've got the point of control 5889. It's just underneath that 5892 cog line that I mentioned earlier for my upside target on this dead cat bounce. The thing is, I'm overshooting my dead cat bounce target, and I know it. It's the idea that we could overshoot. We don't need to go back that far for this to be a dead cat bounce. We've gone far enough. It didn't even need to go as far as we did. This is the idea that we fell down into support. We bounced on support. We're looking to rally into resistance. That resistance is expected to hold, and then we make our move back to the downside, and we retest the support that we had already hit, but we also retest that low that we created. And then we'll see if we're going to go down even lower from there. We did overshoot the point of control that we had mentioned, that 5832 cog line, and made it all the way down to the roundy. Below that, 5792 cog, and then the point of control 5758. So it is worth noting that the range that we're focused on, we could break that down by itself. We can focus on the idea that it's a part of this wider range. Let's just kind of line it up. Oh my goodness. Not that. Using the high from back here and where it pulled back and then it broke out. There's 1.5 and 2%. We didn't quite get to that 2%. It's still on the table if we can get back above 5882. But we have to get back above the 5882 to put that into play. Otherwise, if we fail to get back above the high that we'd already set, then what you're looking at is the peak, lower high, lower high, lower high, lower high. Right now, that is the number one focus, is that high right there and this low right there. So the dead cat bounce didn't need to even come back as far as it did. It certainly doesn't have to go to 58.92. We are back at the 10-day and the 3-week. So if we were going to reject and go down, this is a really good place for that to happen. If we didn't have job numbers this morning, I would already expect that, and I wouldn't even worry about anything more on a dead cat. But if we do continue the move to the upside, we have the volatility trigger up there underneath that 58.92 cog line. It is worth noting, if we get completely out of yesterday's range, there's not going to be a whole lot left to work with, right? We're already up, say, 0.5%. If we continue the move from here and we get, say, just to yesterday's high, that's another 0.43. We'd be near a 1% move at that point. If we get to the 111, which lines us up with Tuesday's high, then we're over that 1% move. 1% in the ES is not much. I know it may look like a lot, but a 1% move isn't much. But that just gets us up to Tuesday. We could still take out Monday's high and get a new high on the week. Or to the downside, as much as yesterday may have seemed like a lot, it wasn't much. And now that we've bounced and we've started to form a resistance here, we could continue the move. And if this is a dead cat bounce, then that is the expectation, right? You get the bounce and you continue the move. With that in mind, it would be 57.50 and then 57.32, 57.11, and 5700. And if you keep track of what Spot Gamma has been posting in their founders notes, that's when we would really start to get concerned, under 5700. 10-day, 30-minute volume profile. I had mentioned yesterday how we had the opportunity to maybe see it contract into this narrow range. But now that we've broke down, that is off the table, and we've put this lower volume shelf back into play. We're going to lose most of this volume through the next few days, but we now have a little bit over here. So it's going to keep this profile really wide because of that. We still have the point of control overhead. And when we get on the next page, we can see what kind of volume we ended up with yesterday. But I don't think we got into any sort of real iceberg down there. Yeah, not much. I think it's really close to a VPOC underneath this. It's worth marking for the day, because even if we did touch it, we certainly didn't close through it. $58.38.25 VPOC from yesterday. So if we do make a move to the downside, watch that level. See if we get a response there. Otherwise, if we continue the move to the upside, we've got another high volume shelf or high volume node just above 58.70. And then we've got that 58.92 area, but we can see there's not a lot of volume structure up there. We spent a lot of time there. TPO would show that we were up there quite a bit, but that wasn't where the volume was. We can really see them unloading on it before the dump came. That's fantastic. So now this morning, we don't have agreement between TPO and volume profile. There's been more trades in the lower portion, but there's been more volume in the upper portion here. It's likely we'll see the TPO's point of control move soon, and they'll be in agreement. A move back down when we get the economic data this morning, 58.50. It's going to be a level of interest. So we've got a lot of trades already there this morning. It's interesting to note we didn't have hedging this morning. I think the job numbers today are one of the biggest numbers we're going to get for the week. I'm really surprised that we don't have hedging. We're back to the 10-day, so this is a reset. You can consider it that we're back to the mean. It doesn't owe us anything at this point. We're in the center of the basketball court. We could go either direction from here, 1.5%, easy. Nothing says that we're going to make a move like that, but we could, because there's nothing in our way to hold us back from that. On the week, we're still above the 10-week by 2%. That's just a good, healthy range. It's exactly where we would want to be. Not overbought, not overextended. We're doing just fine. The reason I brought this page back up, if they were hedging this morning, we would see it, right? It would be up here. If you don't have that label and you can't see it, we would be able to see it in the options chain. If the front expiration is higher than the next expiration out, then you've got a market maker move. And we don't have that. So we don't have a market maker move. And if we did, it would imply that they're worried about something and that they are hedging. Volume's a little light, nothing drastic or concerning. 60 is fine. In the last week or so, we've seen 48 and 52, 55. So 60 is no problem. But again, that shows the lack of concern. They're not hedging. They're not sitting out. They seem really comfortable with that consensus estimate of one data print, 1 point lower. I don't think so. But, do the devil's advocate. What if this is spot on perfect and we just get that one tick higher? Then it's likely that we don't see a big candle print. We don't see a big response out of the market. And then we'll focus on some of these other economic events that we have on the day. Right. So while I'm really hung up on these job numbers, if they don't offer volatility, then you're definitely going to want to look at the clock and keep your eye on some of these others. Well, commodities and consumer discretionary are leading, but it's nothing more than an algo print, right? We could find them way up here. They're just a little print. There's no real flow to them at all. Get into the Bitcoin one. Now we've actually got some flows, right? Shows the two-sided trading, liquidity. So we got Bitcoin, consumer discretionary. We got some ag, commodities, gold, gold miners, semiconductors, silver, precious metals, uranium. It's like a full tilt, right? Everything is up except pot stocks and China internet ETF. That's it. Pot stocks and the China ADRs. Everything else is up or working on being up. So we have the capacity today for one of those face ripping rallies, just like yesterday really burned some people to the downside. I think this, if we get that rally, it's going to really burn some people to the upside. Seven percent of the S&P is down more than 0.5%, but 18% of the S&P is up more than 0.5%. And looking at the names that are in there, a lot of semiconductors, some software, the Mag 7, FedEx came up with UPS, GM, Ford, Tesla. So Tesla brought up some of its car buddies. In the NASDAQ, 7% is down more than 0.5%. And 34% is up more than 0.5%. 34 is a pretty good number. You know, it would be better if it was above 50 or 70 names, but I mean, that's a rare day to find something like that. 34% is a good number for names that are up at least 0.5% in the pre-market at this time of the morning. We get closer to 9:30 and you run this, that won't be so impressive. You'd want a bigger number at that point. We could certainly see all of the semiconductors in there getting a little help after the shenanigans that we've seen lately. And then Tesla, a couple other Mag 7s in there. But these are the names that we would want, right? That's the sector in the industry that you would want to see. And it also fits in with a little bit of a mean reversion at this point in that context too. These are changes over 5 days. So you can see XLF, you know, is still down 1% after this fade off of the high. It would make perfect sense that we get a bump and a rally today in that. Same thing with tech. You know, if we're setting those lower highs and lower lows, well, we got our lower low. Wouldn't hurt to rally up and set a new lower high here. After a while, it'll start to look a lot like consumer discretionary is, where we've got the low set, then we set the lower high. Now we've got a new lower low, get a rally up, get a new lower high, just step by step working our way down, right? That was a nice bounce on the 50 yesterday, by the way. So just step by step, a lot of these that are up this morning were already down enough to kind of earn themselves a little bit of a mean reversion. That would be what I would focus on this morning. Once we get the jobs data, see if it even provides any sort of violence at all. If it doesn't, keep your eye on the clock. Look for any of the others to bring that violence and run with the group that's doing all the work. Mag 7 and all of these names that are up at least 0.5%. You're looking at nearly every group and every category up this morning, except pot stocks and the China ADRs. So don't go against the group. That's what I got for you guys. Be careful, be safe, watch the clock. I'll see y'all tomorrow.